Principles of marine insurance. Marine insurance is based on fundamental principles that ensure fairness, transparency, and legal enforceability in contracts. These principles apply to all types of marine policies, including hull insurance, cargo insurance, and freight insurance. These principles are discussed below. 1. Principle of utmost good faith, Uberrimae Fidei. The principle of utmost good faith requires both the insurer and the insured to act with complete honesty and transparency. Failure to do so can render the policy void. Example: a shipping company insures an old cargo vessel but deliberately hides the fact that the ship's engine has a history of frequent breakdowns. Later, the engine fails during a voyage, leading to delays and financial losses. When the company files a claim, the insurer discovers the unreported engine issues. Because the company violated the principle of utmost good faith by withholding critical information, the insurer denies the claim. 2. Principle of insurable interest. The insured must have a financial stake in the subject matter of the insurance policy at the time of the loss and used as a tool for compensation. Example: an exporter sent a consignment of under FOB, free on board, terms, meaning ownership transfers to the buyer once the goods are loaded onto the ship. However, if the ship sinks after ownership has passed to the buyer, the exporter no longer has an insurable interest and cannot claim the loss. Only the buyer, who now owns the goods, can file a claim if he has a valid policy in his name. 3. Principle of indemnity. Marine insurance is designed to compensate the insured for their actual financial loss, not to provide a profit. The insured should be restored to the same financial position they were in before the loss occurred. Example: a trader insures a shipment of coffee worth $200,000. During transit, half of the cargo is damaged in a storm. The insurer compensates the trader $100,000, the actual loss, rather than the full insured amount. If the trader had overinsured the cargo for $300,000, the payout would still be based on the real value lost, $100,000, not the inflated sum. This principle ensures that insurance remains a risk mitigation tool rather than a means of financial gain. 4. Principle of subrogation. Once the insurer compensates the insured for a loss, the insurer inherits the insured's legal rights to recover the amount from any third party responsible for the damage. Example: a cargo ship collides with another vessel due to the negligence of the other ship's captain. The cargo owner files a claim with their insurer for $500,000 in damages. After paying the claim, the insurer takes legal action against the negligent ship owner to recover the $500,000. If the insurer successfully recovers $600,000, the excess $100,000 may be returned to the insured, depending on policy terms. Subrogation prevents the insured from double recovery, claiming from both the insurer and the negligent party, and helps insurers offset their losses. 5. Principle of contribution. If the same risk is insured with multiple insurers, each insurer contributes proportionately to the claim, ensuring the insurer does not profit from overlapping policies. Example: cargo worth $1 million is insured with two companies. Insurer A covers $600,000. Insurer B covers $400,000 if a fire causes $500,000 in damages. Insurer A pays 60%, $300,000. Insurer B pays 40%, $200,000. This prevents overinsurance and ensures fair distribution of liability among insurers. 6. Principle of proximate cause, causa proxima. When a loss is caused by a series of events, the insurer is only liable for the loss if the proximate, or closest and most direct cause of the loss is covered by the policy. The insurer is only liable if the dominant and most direct cause of the loss is a covered peril under the policy. Example: 1. A ship carrying electronics is caught in a storm, covered peril, but is also hijacked by pirates, excluded peril. If the ship sinks primarily due to the storm, the insurer covers the loss. However, if the main cause is piracy, which is often excluded, the claim is rejected. 8. Principle of contribution to general average. When voluntary sacrifice or expenditure is made to save the maritime venture, the loss is shared proportionately by all parties involved. Example: if a container of goods is thrown overboard to lighten the ship during a storm, All cargo owners and the ship owner share the loss, not just the owner of the lost cargo. This is settled under the general average principle, a unique feature of marine insurance. 9. Principle of warranties. Warranties are conditions that must be strictly complied with. They can be express, stated in the policy, or implied, assumed by law. Example: a warranty may require that a vessel must sail within a certain date or be seaworthy. If a vessel departs late or with a known mechanical defect and a loss occurs, the insurer may deny the claim for breach of warranty. 10. Principle of seaworthiness, implied warranty. There is an implied warranty in every marine insurance contract that the ship must be seaworthy at the start of the voyage. Example: if the hull is corroded or lifeboats are missing at the start of the voyage, the ship is unseaworthy. If a loss occurs due to these issues, the insurer may not pay the claim. Thank you for watching the video. For more marine topics, please subscribe the channel. Please help us with your valuable feedback to improve the contents.